This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we've looked at generic strategies and we've looked at strategic direction, like going into a new market or a new product. Now we have to look at how the strategic directions might possibly be achieved. And the first two methods we're going to be looking at is merger and acquisition, and then organic growth. So merger and acquisition, where one company takes over another company to form a larger group. And organic growth is where you reinvest profits or indeed raise more capital yourself and start up the other enterprise. And the way we're going to tackle this is just to look at the differences between some of the characteristics of merger and acquisition and organic growth. So what I'll do is I'll put over here merger and acquisition, and here organic growth. And we'll just look at a couple of the characteristics. I'll call them characteristics rather than advantages and disadvantages, because sometimes it's not altogether clear to know which is which. The first one I'll look at is speed. So you want to get into a new country quickly, or want to launch perhaps a new product range quickly, then fairly obviously merger and acquisition is going to be relatively fast. You can take over a company which is already in the country, or a company which has already got the product range you want, and you're kind of instantly there. Whereas organic growth is going to take some time to grow your market in the country, or maybe to develop the product. So this is slow. Second element we can look at, or characteristic we can look at here, is need for capital. And fairly obviously, merger and acquisition requires immediate capital, either cash or the issue of shares, to acquire the company. Whereas organic growth could be funded by retained profits. That might be a little bit slow, but it can be often spread over a number of years, even if you're raising external capital. So this is fairly immediate, whereas perhaps this one is more gradual. Third element that we'll look at is risk. This gets slightly more interesting. Which method of expansion has got the greater risk? Merger and acquisition or organic growth? Well, with merger and acquisition, always remember that a seller has more information than a buyer. The seller of a second-hand car knows more about its defects than the buyer is ever likely to find. And there have been many mergers where the company that's been taken over turns out to be a bit of a disappointment for the buyer. It's not indicative of fraud necessarily. It's just the buyer will talk it up, and the seller will talk it up, and the buyer maybe pays a little bit too much. So there's certainly risk here that you end up with a company which has actually got less in it than you thought. And occasionally there have been mergers and acquisitions where the company that's been taken over has been discovered to be really an out-and-out fraud with very little in it. Organic growth is not without risk. If you're going into a new country and you decide to do it on your own without any prior experience, then really going to learn by your mistakes. Similarly, if you decide to develop a new product really from scratch, there are a lot of missteps you can take within that. So organic growth has got substantial risks as well. They're different risks, but nevertheless they are substantial. Cost. Well, if you buy a company which is already running, assuming a successful company, you're going to be paying here for goodwill. There's nothing wrong with paying for goodwill. Goodwill gives you access to additional profits because of, for example, the reputation of the company. But you have to be careful that the valuation of goodwill is reasonable, and you can get into a kind of bidding war if there's another potential purchaser there, and it gets very kind of macho and nobody wants to give way. And you can end up paying too high a cost. Organic growth is probably the cheapest way. Leaving aside, of course, the risk characteristic here, but essentially you are buying assets, non-current assets at cost price. Although you have to wait then for a while and hope that the profits of the company are going to, maintain that the amount you paid to develop this product ends up with basically a positive net present value. The final element I will put in here is disruption. Mergers and acquisitions tend to be highly disruptive. Personnel, the employees feel very nervous because they know that generally after some sort of merger and acquisition, there's very often redundancies. Even if there's not redundancies, they're going to be maybe subject to a different boss. They're going to have to get used to different working styles. Maybe their job will change. And many people, if they can, get so unsettled by merger and acquisition, they will leave. And very often it's the best people who leave. Generally speaking, people will say that disruption in a merger and acquisition is likely to last about 1 year. I, in my life, have been through 2 mergers and acquisitions where the company I worked for was taken over. The first one I stayed, and the second one I decided that I didn't want to go through this process again, and I left. However, organic growth has almost no disruption at all. What you see in organic growth is your company is expanding, it's opening new branches, and so on, and you see really opportunities open up as the business expands. And you think to yourself, if it keeps expanding, maybe in a year or 2 years' time, I could be in a managerial position in that new branch. It tends to be in merger and acquisition, you have the feeling that maybe opportunities close in, that maybe a manager from another company comes in above you, taking the job which you expected to have. Other methods of growth. First of all, joint ventures. Joint venture happens where you have company A, company B, and what they do is they produce a joint venture company. And what they do is they put into this some capital. They may transfer assets. They may transfer human resources. They may also transfer know-how. Joint ventures are very popular for large, complex projects. One of the most successful joint ventures in the last 25, 30 years was Airbus. Airbus was set up as an organization to produce a new range of civil aircraft, really to challenge Boeing, which had a very dominant position in the market. And if you think about it, when you're one company to take the risk and the gamble of designing and selling a new range of civil aircraft, it's going to be very expensive for that company, a lot of risk if this didn't work that would maybe ruin the company, a lot of expertise and skills needed in that, perhaps too much for one company. And what happened was 4 European aerospace companies joined together in a joint venture to develop the Airbus. It proved very successful, and then what they had to have was an exit strategy. How do these joint ventures get their money out? And the way it was done with the Airbus was it was floated on a stock exchange, and people who wanted out could get out. Very popular for these large, complex, risky projects. What you need to make sure is every avenue of contention is covered. What happens if you feel somebody's not pulling their weight, not putting in the right know-how? What happens if somebody wants to leave early? Maybe other financial pressures say that they have to leave. How the profit's going to be shared at the end. It's a bit like marriage, where people might suggest you need a prenuptial agreement to specify how the assets are going to be split up if the thing comes to grief. Licensing is a very low risk way of expanding abroad. Basically what you do is you allow somebody else to use a process or maybe a brand. It's very popular, for example, in Europe to license the manufacture of beer. Beer is essentially pretty much water, and if you think about it, there's not much point in making beer, perhaps in Belgium, putting it into a boat, sailing water across water, and then distributing it perhaps in the UK. So what a foreign beer company can do is to license a UK company to make it to their specifications and then allow them to brand it. You can get similar things in the manufacture of Coca-Cola. Coca-Cola concentrate is transported to the other country, and then essentially the Coca-Cola is bottled and sold by a licensed company. What happens is the licensor, the Coca-Cola or the original brewery, they take a royalty. So you can get this very international kind of distribution without having to set up factories and your own distribution centers in foreign countries, which is where a lot of the risk is. What you do is you let somebody else do it and you take the royalty, and it's relatively risk-free, provided they make your product to the right specifications. Franchises are a bit like licensing, but rather more hands-on, I suppose. So let's take the example of McDonald's. So that McDonald's, a hamburger chain, and let's say that I had a long-standing ambition to run a hamburger shop. So here we have myself. Now obviously I could set up a hamburger outlet on my own and put above the door Ken's Burgers or something of that sort, but that's not going to have a great market presence. Nobody's ever heard of that before. There's a lot of risk involved therefore. So what I do is I approach McDonald's and say, I would like to run a hamburger shop. Can I be a franchisee of you? McDonald's is a franchisor, I am the franchisee. And they will kind of size me up and so on. And if I pass their various scrutinies, then what I will do is I will buy into the franchise. That's worth me buying in because the risk is much lower. The chance of a McDonald's franchise not working is actually fairly low because they've got great expertise in where to set it up and how to run it. And then they will provide me with the following, typically. They will provide me with some help, assistance. Where to set it up. Not too close to other places you want a good passing traffic and so on. They will also provide some training. They provide some raw materials. They will provide some research and development so that new products are going to be developed kind of centrally. I don't have to pay for that. They will provide some marketing. So if McDonald's can advertise on television, I, as just Ken's Burgers on my own, couldn't possibly afford that sort of advertising. Note that they provide me with raw materials. They will normally say you can only buy raw materials from us. And there's another stream here of money going from me to McDonald's. I will not be permitted to go to cheaper suppliers and source my own raw materials. And also what they give in a very big way is going to be rules. It's McDonald's interest to try and make sure that each one of their outlets follows a set of very, very well specified rules so that all McDonald's outlets effectively are the same. They will specify when there are special offers on, they will specify when the opening time should be, they will specify how long the waiting time should be to be served and so on. And this is where very often franchisees break down a little bit. I thought I was setting up my own hamburger shop under the guidance of McDonald's, but actually maybe what I discover is I'm not much different to an employee. However, it allows McDonald's to get cash up front. As it expands, it gets some of the upfront cash here. It allows McDonald's to keep a very, very lean head office. If I find out on Monday morning that somebody has broken a window on a Sunday evening, I don't bring up McDonald's repairs and maintenance. I have to find the glass repairman myself. So the head office is kept very, very lean. And the final bite of the cherry they get is very often a royalty. I'm not saying McDonald's is exactly like this, but these are the typical three flows of cash the franchisor gets. People have to buy in, then they have to pay for the raw materials and so on at a price dictated by the franchisor, and then there's a royalty based on either profit or revenue. And you can be sure that these payments are arranged to make, some incentive for me, but probably not enough to make me fantastically rich. But it's a very, very popular way of international expansion. Many retail outlets work on a franchise model. Finally, we have strategic alliances. This is a very kind of loose arrangement, really to cooperate. And a good example are the airline strategic alliances, and indeed one is called Star Alliance. Star Alliance has got Lufthansa and some of the Asian airlines in it. It's got some of the Americans one in it. I think it's got Air New Zealand in it and so on. And by a kind of cooperation that you're getting here, then you can effectively service the world. Whereas if you were just Air New Zealand, for example, your route network is going to be very constrained indeed. So a strategic alliance, there's no co-ownership of anything of that sort. It is an agreement to cooperate so that all parties to the alliance can present a better service to the public. The last section in this chapter deals with something called portfolio management. And portfolio management really deals with the relationship between head office and its various subsidiaries. How should the head office manage these subsidiaries? And there are three ways. First of all, there is what's known as portfolio managers. And portfolio managers is very much the way in which you would manage a personal portfolio of shares. So let's say you had 5 different sorts of shares. Maybe you had Sainsbury's, British Aerospace, British Airways, Marks & Spencer's, GKN, 5 listed companies. The only thing that you can do as a private investor is to decide whether they are doing well enough for you to keep them or whether you want to get rid of them. You cannot interfere with the day-to-day management of these investments. You have to be inevitably very hands-off. And this is what happens in a group where the attitude is portfolio management, although obviously the holding company could interfere with the management of the subsidiaries. It chooses not to. What it does is it gives these subsidiaries targets, profitability, earnings per share, return on capital employed, all sorts of financial targets. And if the subsidiary hits those targets, then all is well. If the subsidiary doesn't hit those targets, then it may remove the management, replace them, or may decide that I don't want this subsidiary in my group at all. So it's very, very much hands-off. The second one is synergy managers. Synergy managers is where there's a kind of mind really behind the construction of the group. And what you have is a deliberate ploy or policy really of constructing the group so that we get synergy. We save costs or we can increase revenue because they're together. An example might be a company which, for example, one of them sells solar panels. And another quite separate company sells what I will call double glazing. For those of you who don't know, double glazing is a window with 2 sheets of glass which provides very good thermal and indeed sometimes noise insulation. So these are 2 separate companies, but think how well they might do if they were to merge, because then what you could do is you could say, well, people are interested in saving heat, generating their own electricity from the sun and so on. There's a kind of ecological impetus there. What these people could do is they could offer maybe a deal. If you replace your windows with the double glazing and you get solar panels, then maybe you save 25%. Or they'll have a customer lists. These are all the people who bought solar panels last year. What about writing to them and seeing whether or not they want to invest in double glazing? There's a real mind, a real kind of strategy behind these to make use of synergy. And the final type of portfolio manager is called parental developers. This is the more complicated one. This is where holding company really takes the place of like a parent and has got a relatively young, small, inexperienced subsidiary which it will help as a parent would to a child. Now, to see how this would work, we need to go to the next slide. And this Ashridge portfolio display here, this is to do with parental development. And I'll describe it first in terms of people with their children, and then we'll describe how it would actually work maybe in a more proper business kind of environment. So what we have here, don't worry too much about the writing at the top of the screen, but what we have here is we have along the bottom here we have benefit. And benefit is really saying how much could the young subsidiary or the young person benefit from being helped by someone more experienced. Up the side we have feel, and this is how much the parent or the holding company actually understands what help the subsidiary or the child needs. So if you're going to get really high return on this, the child must need help and the parent must be able to provide the right help. So for example, when my children were young, they needed help reading. I can read. So what I could do is I could go through reading books at night with them, pointing to the words and so on, and I could get them to read out and I could read whilst they watched and so on. That was great. That really benefited these people because they needed help with reading and I could provide that help. Now my children are grown up. They read perfectly well. The first example was this Heartland business where it could really help them. Now they are grown up. They don't need help reading. There is no benefit to be given to them anymore by going through books in the evening and so on. I can still read them, but it's not going to do any good. They're not going to get any better. They're not going to get any worse. But it's a kind of standstill. It's a kind of waste of time because you don't need the benefit. Moving down here, again going back to my children when they were young, we wanted them to learn piano. So they needed help, knowing where the notes were, scales, etc., etc. No point in me trying to do that. I don't play the piano, and although I might try to sit down with them and try to point out the notes and so on here, my ability to actually help them was severely limited and I might have been doing damage. What they needed for help was my wife, who plays the piano, and she could have provided the right help. It would be more a heartland business. And it's called value trap because you maybe feel you can help and you try to help, but actually you're providing the wrong sort of help. You're actually potentially doing damage. And finally, we have alien businesses here. This would be like if my children could now play the piano well, and I had the presumption to try to correct them or to improve playing the piano. Not only do they not need help, but they're getting useless advice from entirely the wrong person, and this is likely to alienate them considerably. So that was a kind of family explanation of what was going on within that. Let's put it into then a kind of a business context and see what was happening. And let's say that the holding company is a company called GlaxoSmithKline. So GlaxoSmithKline, or GSK, is a very large, successful international pharmaceuticals company. And what pharmaceuticals companies are particularly good at is research and development, drug trials. That's necessary to make sure the drug actually works and that it doesn't do any damage. And they're very good at marketing, because the cost of developing drugs is huge. They have to be able to market these really on a worldwide basis to cover their costs. So those are the three things that Glaxo is very good at. This is potentially areas that it could help another company in. And let's say that one of the companies it discovers is a small biotech company. So a small company, perhaps a spin-off from a local university, has discovered a worthwhile drug. It has done the research and development. But almost certainly what this small company will not be able to do is to carry out the clinical trials. These can go on for 5 to 10 years, and they are immensely expensive to run. And almost certainly this small biotech company will know nothing about marketing, and certainly nothing about international marketing. Now this would be the perfect target for Glaxo to take over. The company has got the discovery, now it needs help in performing the clinical trials and then carrying out the marketing. That would be very much heartland business. Secondly, let's say GlaxoSmithKline is looking at AstraZeneca. So AstraZeneca, another very large, successful international pharmaceuticals company, but AstraZeneca doesn't need help. AstraZeneca is good at research and development, knows all about clinical trials, and is very good at international marketing. And if Glaxo, they understand each other perfectly, but if Glaxo were to take over or merge with AstraZeneca, then you're getting a bit of a balanced business. You won't necessarily be doing any harm, but the two together will not do maybe significantly better than the two apart. So it's a bit of a waste of time. And then let's say Glaxo is looking around for little investments and so on. It discovers a little company, maybe this had to be some years ago. I think it was called Rovio. And you may or may not know the name Rovio, but Rovio was the computer game company which invented a game called Angry Birds, which is a great way of wasting time. Finnish company. And you can imagine that Rovio had invented, done the research and developing, had developed a nice little game, but I don't think it would need probably clinical trials, but knew nothing about marketing that internationally. And you get Glaxo coming along saying, we know about marketing, we will take you on, we will teach you about marketing. And that is a value trap business. Rovio does need help in marketing, but it doesn't need help in marketing the sort of things Glaxo knows about. Glaxo knows about marketing pharmaceuticals. It knows nothing really about marketing computer games. And the final example might be that Glaxo looks around and sees Nintendo. Another company in the computer game market, but a very large, successful company in the computer game market. Not only does Nintendo not need much help in marketing, but Glaxo doesn't know anything about marketing Nintendo Wiis and computer games and so on. This is very much the alien business. It's completely inappropriate for Glaxo to take over Nintendo, which doesn't need help, and about which Glaxo knows nothing, and can provide no benefit, therefore, to Nintendo whatsoever.